Well, thanks very much. Thank you, everybody. As Alan says, Craig Field. I'm from Ryan Gear Field and Roads. Little practice we have in Matthews. We do small business and individual tax returns, accounting and business planning or financial planning. Valuations particularly is my interest area. So what I wanted to do today is just provide you with an overview, some of the key tax issues in 24 and 25. There's not been a lot of changes, but there are issues that I think will be useful for you to know about. So my intention here is to introduce you to those concepts, and at least you'll be able to bring them up with your CPA or tax advisor when it comes time to file your taxes this year. In 2023, see if I can operate this thing. In 2023, which is the last fiscal year, the US government collected, well, it's the last fiscal year that's been properly accounted for. The US government collected just over $4 trillion in taxes, spent $6.1 trillion, which accounted for a deficit of 1.7 million. The importance of that is that most advisors will tell you that you should be thinking about tax rates going up in the future. Because of these ongoing deficits, the general thinking and the general belief among most advisors, I think Alan would agree, is that if you're planning for the future, probably expect rates to go up. Now that can change, and politicians want to get elected, so they'll do whatever they need to do. But most of the planning that we think about is what do we do on the assumption that rates are going to go up in the future. Our income tax system works on a principle of the more you earn, the more you can afford. It's kind of an underlying principle of our tax code, and it's not dissimilar from most of the Western world. The more you earn, the assumption is that you can afford to pay more tax. And so as a result of that, we have a bracketed tax system, which basically puts everyone's income into a bracket and then levies various taxes based on those brackets. And so here you can see for each different tax bracket, those percentages across the bottom of the bottom end of the tax brackets, and then what income do you need to earn in each of those brackets depending on your filing, the way you file. So S is if you file single, that's someone who's unmarried. Head of household is someone who's unmarried but has dependents, like children. And then married filing jointly, which is probably the commonest or second most common filing, that's anyone who's married. If you are married, you file either married filing jointly or married filing separate. That's it. You can't go and file head of household if you're married. So you've got to do that. So you can see now from in the 35% tax bracket, the top tax bracket, you've got to earn this year about $750,000 or more to be in that top tax bracket. One of the things I wanted to talk about, this concept of these tax brackets, is marginal taxes. I have a lot of clients that come into me and say, well, I'm in a new bracket, so now my taxes are going to be higher. Marginal tax, which is simply the amount of tax you pay on the next dollar of income. So as you graduate from a 10% bracket to a 20%, 12% bracket, and then to 22, doesn't mean that all your income suddenly gets taxed at a higher rate. That's not the way it works. It just means that every dollar extra is taxed at a higher rate. So obviously the more that is in the higher tax brackets, tax rates, the higher your average is going to get. Nobody's going to pay tax at 37% unless they're earning in the mega millions. If you're at 750,000, your tax rate is an average of all those, 10% through 35. So you're probably somewhere in the 30%. You get to $1 million, a lot more of your income is being taxed at 35%, so your average is going to be higher. So just an important thing to think about. When you get an increase, someone says, I'm going to get an increase, that'll push me to a new tax bracket. That's not really how it works. It just means that little bit of extra income is going to be taxed at a higher rate. All the taxes that I've talked about there, those tax brackets, they apply to regular income tax. there are also, those are the tax rates that you pay based on your taxable income. So that's income from wages and earnings from a business and that sort of thing. You also get taxed on dividends and capital gains, long-term capital gains, qualified dividends and long-term capital gains. That's dividends from public stocks, for example. If you own AT&T and you get a dividend, that's a qualified dividend. If you go and sell those AT&T stocks and you've owned them for a year, that's a long-term capital gain. If you earn, the basic rule that this is setting out, that if your taxable income, your total income that you pay tax on, is in those bottom two tax brackets, so in the 10 or 12% tax bracket, you pay 0% tax on qualified dividends and long-term capital gains. So an important planning feature for retirees, for example, if someone's going to retire and their income's going to drop substantially, good time to start realizing some long-term capital gains, maybe. Do some capital profit harvesting to get those gains and try and get them into that area where you pay 0% tax. Conversely, if you're in the top tax bracket, this 35% bracket, you pay 20% on long-term capital gains and qualified dividends. Everything else in the middle is 15%. Most people I see, most tax returns I see, the effective tax rate, if you look at the amount of tax they paid compared to their total income, usually in the region of 10 to 15%, maybe as high as 20. So you don't really save a huge amount by having your capital gains at 15%, but if you have a big sale, you have some big liquidating event that pushes your taxable income up, then it'll make a difference. State taxes. State taxes are the same for everybody, for all of these incomes. So in North Carolina, we pay 4.5%. It doesn't matter whether it's a capital gain or a dividend or wages, whatever, you pay 4.5%. South Carolina, it's between 6 and 7. They have a graduated scale there, but you either pay 6 or 7% there. So we talked about the planning with, just look at that, if you have a liquidation event, so that would be a business sale, or you're going to retire and you want to take a bunch of money out of your IRA or your 401k, anyway where you're going to have a big chunk of money coming in, think about things like we've talked about here, about maybe making use of long-term capital gains or dividends to try and get a lower average tax rate. It's all about planning and thinking ahead. And yeah, okay. Let me just catch up on my notes here. Standard deduction, yes. Also part of our progressive tax structure is that if you earn below a certain amount of income, you don't pay tax. So the assumption is that if you're single and you earn less than $15,000 a year, you shouldn't have to pay tax, which is probably fair. I mean, you can barely get by on 15 grand a year. There are a lot of credits available to low-income people. There's credits available to parents. You probably all know. You get $2 grand for every child under the age of 17 as a tax credit, which is actual money. That's not a deduction or anything. You get an earned income credit, which is a really nice credit. That could be $5-6 grand if you're in those lower tax brackets. So there's a lot of assistance for lower earning individuals. Our topics for this year: energy credits. The Inflation Reduction Act came through. That extended a lot of the energy credits. I think most people are familiar with those, like your $7,500 on an electric vehicle. Those have been extended. You know, there was a period where you didn't get the deduction on Teslas because they sold more than 200,000 vehicles. Well, that's back now. So you can get it on a Tesla and all the other EVs that are out there. Don't come across this very often. Excess business losses. If you have a business that loses $305,000 and you're single, or $610,000 and you're married, you cannot deduct anything in excess of that. But if you're losing that amount of money, tax is probably not your biggest issue. RMDs are a big issue. And this is because of the Secure 2.0 Act. So RMDs are where you have to take money out of your IRAs. The IRS gives you a tax break to contribute to IRAs and 401ks, but when you get to a certain age, they want that tax back. They force us all to take our money out of those qualified plans. There's exceptions around that and ways of planning. That age for RMD has gone from what used to be 70 and a half years, went up to 72, now it's 73, and I think it's 2030 it goes up to 75. Do you know the year?
I think so.
It's coming up, it goes to age 75.
Are you going to talk about qualified charitable distributions too? Or?
We could touch on that. I may have had a slide on that.
Is that changing too? I know 71 is when you can start doing that.
There was something on that. Qualified charitable distributions, just so that you know, is so the standard deduction, we talked about the standard deduction a moment ago. That includes standard deduction can be taken, or you can claim what's called an itemized deduction. An itemized deduction is made up of medical expenses above a certain threshold, state and local taxes, mortgage interest, and charitable deductions. With standard deductions at $29,000 for a married couple, very difficult to contribute enough to a charity, even if you have a mortgage. Say you've got a mortgage of 10 grand interest a year, and your state and local taxes are 10 grand, that's 20. You've got to contribute $9,000 to a charity to even qualify to use itemized. You might as well just claim the standard deduction. So a lot of people are not contributing to charities. But if you are, and you're getting an RMD, or you're having to take money out of your IRA, you can take this option that Alan mentioned of have the IRA company pay the contribution for you. So the money goes directly from the custodian to the charity.
And nobody gets taxed.
And the advantage is it doesn't get taxed, so it doesn't go into your income. You don't get the deduction, but you're not going to get it anyway because it's under the 9 grand or whatever that you weren't going to claim.
Is that new this year?
No, that's been around a couple of years.
And
there was
the age is 71. You're not allowed to do it until you're 71, but I didn't know if that
Yeah,
was something.
yeah, and there's something else about 100,000 that, and I'm not sure if it's in the notes still, but I'll look it up and get back to you on that.
Yeah, it's great. Your pastors and priests will love you if you tell them.
Yeah, for tithing. So that's important. Again, another thing on the planning side is a lot of people say, I don't want to take IRA distributions because I'm going to pay tax on it. Just look at your brackets and look at where you start paying tax. It might actually pay you, even if it's before RMD age, to start taking some IRA contributions, because if your tax is low enough, you can start getting the money out at a relatively low rate, roll it back into a Roth or into something that's, a brokerage account that's, with capital investments, capital growth investments. You can at least get that income out of the IRA before you start having to take big RMDs. I had a client come in the other day. She's widowed. She doesn't live on much. Very simple young older lady, and she's got $3 million in an IRA that her late husband left her. And I said to her, well, in a year's time, you're going to have to take $163,000 a year. She says, that'll take me 2 years to spend, 3 years to spend. She lives on $50K a year. Social Security is plenty for her, but she's got to take it. So now we've got to say, all right, well, how much tax do you need to withhold to make sure you paid enough? Yeah? You go marry her. Okay. A new thing in Secure 2.0, 529s can be converted to Roths. There are a lot of restrictions on it, so talk to your financial advisor or CPA about it. But basically what they're saying is you may have a situation where you put money aside since Johnny was 5 and Johnny turns 18 and says, no, university is not for me, I'm off to the Navy or the Army. And then off they go, and you've got 40 grand sitting in a 529 plan for school, and Johnny's just never going to go to school. That's not his bailiwick. So what do you do now? You got the money sitting there. You've got several options. You can repurpose it, redirect it to another trustee, another beneficiary, I beg your pardon. But you can also now start taking that money out and converting it into a Roth for Johnny. So Johnny can now use it to spend on something else once it meets those requirements. The Roth has got to be there for 5 years. The 5 to 9 has got to be in there for 15 years. There's a bunch of regs around that. But it's a nice way to help with retirement. I mean, it's a way to take money that would have been wasted otherwise. A lot of clarity needed from the IRS on this still. So just check with the advisor. Yeah.
The Roth has to be for the benefit of the child that the 529.
Well, that's one of the issues. You change the beneficiary, so you change it from Johnny to Susie, and Susie doesn't want to go to school either. Can you now give it to Susie's Roth, or maybe Susie's used up hers, and I don't know. Can you?
Because
we don't
normally
know.
a Roth IRA, can't you normally use that for educational expenses anyways?
You can use it for anything. There's no restriction on what you use it for, as long as it's a qualified distribution, 5 years and all that sort of thing. But why would you if you can use the 5
And you
to
can roll
9?
it from kid to kid, I think.
The Roth, can you?
The 529, you can change kid
Yes,
to kid.
but I don't think
Roth, you can't roll from
Roth
kid
you
to
can't.
kid?
Once you
No.
put it into a Roth for a child, it's that
Yeah.
child's.
Yeah,
Okay.
They can have a beneficiary on it, but it's that child.
yeah. The child's got to die first, which kind of
Yeah.
stinks a bit.
But I can't put it in my Roth.
No, because you wouldn't be the beneficiary.
Roll that out.
No. But that's one of the things that they're looking at is this a way that you can start abusing the contribution limits to Roths? Because your contribution to a Roth is $77,000 a year.
And then
So you could, but there's no limit to a 5 to 9. So could you put your money in a 5 to 9 and then roll it into the Roth?
I love it.
And so, tax planners are quick to come up with these schemes and try and find ways to scheme in the English sense, not American sense. But yeah, those are the issues that need to be clarified, and we're still working on that. The Form 1099-K, I just mentioned it because it's topical. Everyone was talking about, you were going to get a statement from Venmo that for all your Venmo transfers, anything over $600, and everyone was panicking because now they'd have to pay tax on their statement from Venmo. Well, that's still going to happen, and the goal is $600, but they're phasing it in. So it was 20.
Adult Rapid Response, room 3111, Union West. Adult Rapid Response.
What room are we in?
We're on the second floor, you're safe.
Not me, okay. So this is still happening. It's just being phased in. So I don't think there's an issue there. Cryptocurrency, I'm losing track. Where was I now?
1099K.
1099s, we talked about those. Those are the limits. Cryptocurrency. There's a section on your tax return now. It's been there for a couple of years. You check a box to say whether you have sold, exchanged, or traded in any cryptocurrency, Bitcoin, Doge, whatever it is. That's now becoming more formalized. So Coinbase, I know, for example, they will give you a 1099 at the end of the year. So be careful when you check that box, or you don't check that box. You're putting yourself on the line. That's a statement you're making to the government one way or another. And if there's a form out there that says you did have crypto and you sold it and you didn't check that box, you're potentially, guilty of a criminal offense. I think that's it. I wanted to point out exchange of goods. So if you take your crypto and go and buy a Tesla, that is a sale. You have to record that exchange. So just because you go and buy another crypto, if you go and sell Bitcoins or exchange your Bitcoins for Doge or something, that is a sale. You have to record that gain. And the other thing, last thing to mention on this is if you mine any of these currencies like Bitcoin, that is a business. So it gets reported on Schedule C, and it's subject to self-employment tax, which is that extra 15% payroll tax equivalent that small businesses have. Just be aware of that. Education benefits. American Opportunity Tax Credit, that's been around a while. So it's $2,500 of the first $4,000. You're capped out at about $180,000 worth of income, so it's, just be aware of that. If you don't qualify for the American Opportunity Tax Credit, most times I end up using lifetime learning is if you pass the first 4 years. So if you're doing postgrad or if you're doing studies later in life, you would use the lifetime learning, which is a 20% tax deduction. 5 to 9 plans, I think we talked about those. That's where you can contribute. The gains are not taxed provided you spend the money on education, and education can include tuition and board, which is different from the AOTC, which is only tuition. And then we talked about, sorry?
Trade schools, you can use it for trade schools.
Trade schools, and you can actually use it for secondary school now as well. So your kids at private college, then you can use your 5 to 9 plan for that.
So, Craig, if
yeah.
you're funding a college student in the current year, can you put the money in a 529 and then pull it right back out on the other side, or does that have to stay in the 529?
No, I don't think there's a time limit for 5 to 9s. No. That can be funded straight away, but there doesn't seem to be much purpose because you've only got 1 year of gains. Mm-hmm. So, I mean, I suppose if you put it in at the beginning of last year, put it all into SPY and the S&P, and you would have got a 28% growth last year. So that's pretty good. But you typically don't want to invest that stuff too aggressively because it's your kids' education. You don't want them to be going to school when the market's plummeted 40%. So.
Right, but if you put it in, it goes into the 521 tax advantage and it comes out.
No. 5 to 9 is not tax deductible.
Oh.
No. 5 to 9, sorry, I should have made that clear. 5 to 9 contributions, same as Roth, not tax deductible. They are in some states.
Right?
Some states allow it, like South Carolina. They will allow you a deduction for contributions to the state 5 to 9 plan, but we don't.
But not in North Carolina.
So you need to just check which states do it. There are a couple.
New York
Do you have to be a resident of that state then?
Yes. Yeah, you have to
And you
be.
have to, and then you have to use it in that state, or
No.
Not. I'm not sure where. It depends on the rules of the 5 to 9 plan. But my understanding was South Carolina. Each state has its own 5 to 9 plan, I think.
Yeah. So
So if you contribute to the South Carolina 5 to 9 plan, I don't know if that restricts what school. Ellen says not. So, so I don't.
Mine is from New York, and I use mine for my daughter in North Carolina.
Yeah. But does New York give you a deduction for 5 to 9s?
they do.
Okay. Yeah, so some states do. Okay. Charitable planning, I think we touched on the QCDs earlier. This is the qualified charitable contribution or distribution, where you get the IRA custodian to transfer the money directly to the charity. It's a great benefit, that. Donor advised funds, I don't know if you know about them, but we had a classic case of someone who used it very effectively the 1 year. He was a construction guy, and I think it was during COVID. It was a boomer year for construction people, and he made an extra 50K that year, and he tithed every year. He tithed about 10 grand a year. So he took that 50, put it into a donor advised fund. Now 50,000 plus his mortgage and his state and local taxes gave him a really nice itemized deduction for the year. So if he could then make use of that itemized deduction, and then the next 5 years he claims nothing, but he still gets the standard deduction. So the church is happy because they're getting their money from him every year like they always did. He's happy because he got a big tax deduction in the year that he did really well, and he continues to get the tax benefit the years after that. And then so charitable contributions are limited. So if you go and win the lottery, for example, you win $1 million. If you gift $1 million to a charity, you can get a tax deduction, but only up to 60% of your income. So you'll get a deduction for $600,000. The other $400,000 will get carried forward to the next year. So you can roll it forward for 5 years. If you and there are some other things that you can do with charitable contributions. If you have stock, so I have a client whose husband worked for Duke, worked for Duke forever, and he got stock distributions every year. And so he had this huge portfolio of Duke stock going back to the ARC. And we had to go through and calculate, because they did a share split and they did all the stuff with Canada and everything. So we had to go through and calculate the average cost of all those shares so we could calculate what his capital gain would be when his now wife was selling them. And what we figured was better for him was to actually contribute those stock shares to a charity. So you give the stock to the charity. What happens is you don't need to report the capital gain, and you get the tax deduction for the market value of the Duke stock. But that you're only allowed to do that up to 30% of taxable income. So you can't do as much of it as you can for a straight cash contribution. Yeah.
It's something else that's cool about those donor advised funds. You can move money into it to take the tax write-off, but then you can wait to send that money to a charity if you don't know where the charity is going yet. So, and it can sit there inevitably. You can make decisions on where the charity goes 10 years into the future. If you can take the write-off this year.
Yeah. And that's the advantage. You're basically...
And does that money gain interest while it's sitting there, or just
Yes.
stay static? It does.
It's invested.
Okay. 10 years is a lot of time to establish your own charity.
I'm sure it's been taken
Especially if
advantage
that charity, especially if that charity sends your kids to school.
Careful.
We don't do that. We don't do that.
So, net investment income tax. Just wanted to touch on this. This is a section of the code that came in with the ACA, Affordable Care Act, otherwise known as Obamacare. It's essentially a tax to supplement Medicare, and it's basically all investment income over $250,000. So if you earned a salary of $250,000 and you had dividends, say, of another $50,000, you would pay 3.8% on that $50,000 as an additional tax. The interesting thing about it is if you look at your tax form on the second page, it's got your total tax, and then it gives you your credits, so your child tax credit and your foreign tax credit, and whatever credits you get, and then it's got the net investment income tax. And the only thing you can take off that is the tax you paid that year. There's no credits against it. I've got a client who had big overseas earnings. They had a lot of capital gains. They just moved. They were in the process of moving to the States. So just before they moved, they liquidated their entire portfolio and moved it here. So they had like a $1.5 million capital gain. Like 3.8% is a big number. It was like $50K that they had to add to their tax. And because they'd paid tax overseas, in the country they came from, they'd paid tax. But we're not allowed to offset any of that tax against the net investment income tax. You could take it against other tax, but not this. So we had to do some interesting maneuvers with that to avoid that tax. So that's the NIT. For small businesses, again, I mentioned the Secure 2.0 Act. There's a general theme here that government is recognizing that Social Security is potentially 2034, 35. If nothing changes, they're looking at a 20 to 25% cut in benefits, which of course is the year I'm planning to retire, but there you go. So we're looking at a reduction in benefits in 10 years from now. And so government's trying to get more and more people onto 401k plans and their own self-insurance for retirement. So one of the things now is that if you start a small business, and I think you have to have a 401k. Do you have to have?
In North Carolina, you
You
don't
don't
have
have to have one, but you're assumed, all your employees are assumed to have become participants in the plan. I think that's the thrust of this, is that you have to provide a matching contribution for all employees on your company plan, whether it's a SEP or a simple or a 401k, unless you get an affirmative letter from the employee saying, I do not want to be part of this plan. It is the default position is that they become participants in the plan, which means you have to make a contribution. How that works with the safe harbor, I'm not sure, because there are two safe harbors for a 401k plan. If you set up a 401k plan for your business, you either provide matching up to 3% and then 50% matching up to 5%, or you match everything at 3%, I think is the right thing. So you could choose. You either match all employees, whether they contribute or not, at 3%, or you choose to match their contribution 100% and 50%. So if you're doing the latter, the second matching, what do you do now? Do you have to contribute 3 for those who are not contributing? I think you do. So I think all employees, you now have to contribute at least 3%. Would be the
a set percentage to everyone. If it's yeah, and if it's if it's a salary deferral, then you allow them to contribute more or less, and the company doesn't have to give everybody.
Yeah, that's right. If they contribute more, so if an employee contributes 5%, which if you use the 3 and 5, if they contribute 5%, then the employer has to contribute 4 and nothing more. So a lot of my W-2 clients, I'll tell them max out, which is 23%, 23,000 for under 50, and then 30,000 if you're over 50, 30,500, I think, yeah, if you're over 50. So I tell them to max that out. The employer doesn't have to match any of that, except for the first 5%, which they have.
That right now is still only in 17 states as of 2 months ago. So it'll be in North and South Carolina, I'm sure sooner than later. But
At
right now
some
it is
point.
state specific,
Yeah.
not federal.
But this is how small businesses move wealth from the business into their personal world that most small business owners that I come in contact with aren't aware of. And this is how you move wealth in the business.
Yeah, this is one of the big tax planning tools we use. This, and then the big one, the real big saving is the profit share, because you can do profit shares up to $70,000, but it's got to be 25% of salary. So I have a client who's already above the Social Security threshold of 170,000. So any salary they earn above that is only subject to Medicare tax of 2.9%. So you whack their salary right up to, I think it's 250,000 or something. You take 25% of that, and then you can do a profit share right up to 70K each owner. And then that goes into the 401k plan without any FICA. There's no FICA tax on it.
Direct write-off of the business, right?
It's a write-off for the business. The deduction in the company goes into the 401k, no FICA. It's great. The 30,000 you do as an elective contribution out of your W-2, that is subject to FICA. So that costs the company, you and the company, 15%. But that's one of the big tools we use to plan. It's all just deferral.
That's the SEP. Or the,
It's any of them.
It all depends on your personal situation in the business.
The problem with the SEP is that a SEP is 25%. SEP can be employer contribution, but mostly it's employer. It's 25% of compensation, and it's got to be made equally to all employees. So if you're the owner and you want to take the maximum SEP contribution, you've got to make the same contributions for all your employees. So suddenly it doesn't look so attractive because it costs you a lot more and you don't get the recompense from the employees. It's not as if they turn around and work twice as hard or 25% harder for you. So the 401k is better for that because you still, if you do profit share in the 401k, you have to match as well. Same applies to everyone, but at least each person can do the 30,000 elective contribution, which is still quite a good chunk. And you put your spouse on as an employee as well, and you can pay them 30,000. So that's 60,000 between. Sorry.
The employees aren't going to do that. They're going to get the free money.
Yeah, the employees will do the minimum that they need to get the 5%. But you could you as the owner can then employ your spouse, both pay each other 30,000. That doesn't get taxed, but it's a company deduction, and you don't have to match it. Other considerations for businesses. Since the Tax Cuts and Jobs Act came in 2018, and just to touch on that, obviously with the elections, we don't expect that to sunset. That whole Tax Cuts and Jobs Act that brought in the lower tax rates and the 20% pass-through deduction and all those things, that was set to expire this year. It was actually in the code that unless it's renewed, and that is the way it still is, unless it gets extended by an affirmative act of Congress, it ends at the end of 2025. And so next year we'll be dealing with tax rates, which I think it was 37% for companies before. So currently it's 21% for a C Corp. Something worth thinking about. If you're paying only 21% tax in a C Corp and you're paying 22, 25% personally, why wouldn't you have your income go through a C Corp? Well, the main reason is to get the money out of the C Corp, you've got to pay yourself a dividend. So we have one situation where we've got a relatively low earning individual who for various reasons needs to earn her income as a contractor. So we decided to set that up as a C Corp. So all her money goes into the C Corp. She pays 21% tax and 2% state tax. So it's 23% total tax that the C Corp pays. And then she declares herself a dividend. She's in the bottom two tax brackets, so she pays 0% tax on the dividend. So that's her tax rate. That's it, done. And then she takes a small salary, which maxes out her earned income credit, and ends up getting 10 grand back, so on a $40,000 salary. So just don't rule out the C Corp. It's not necessarily a bad thing at the moment. Research expense, just to mention that the IRS came out a while ago and defined research expenditure. Probably not all that relevant here, but if you have research expenditure, you have to capitalize. That means you have to put it on the balance sheet and you can't deduct it for tax. You can over a period of time, but you don't get this deduction right away. It's research expenditure, not research and development. So you can nuance that a little bit. Depreciation, when Tax Cuts and Jobs Act came in, they allowed 100% bonus depreciation. What that basically means is you go and buy a piece of machinery or a computer or a vehicle or something, an asset for your business, you could take, at the time, 100% bonus depreciation deduction for that. What that means is the company is allowed to depreciate the cost of that asset 100% in year one, get the deduction correct. And then that got phased out. So it was 80% in 2023, 60% in 2024, and so on. It's being phased out. The other deduction that people get, which is very similar to depreciation, is Section 179 deduction. Also allows you to claim 100% deduction for the cost of equipment purchased, but it gets deducted on your personal tax return. It's kind of a weird thing. But you get it, it's limited not by the deduction, it's limited by the amount of equipment you purchase. So if you're a General Electric, this is going to affect you because you may buy more than $1.2 million worth of equipment. But for most of my clients, they don't buy anywhere near that level of equipment. So what we can do is claim the 179 deduction for them and the bonus. We can claim bonus for 60% and then 179 for the difference. The problem with 179 is if you have a loss, you can't claim it. So some rules around that. I'm not going to go into these, but talk to your CPA about them, see if it's applicable. There are credits available for businesses. Just a reminder of deadlines for the year. If you have a S Corp or a partnership, that's due March the 17th, and it can be extended to September 15th. So you can apply for an extension. No charge to that. It's easy. You just file a 7004 form, get the extension. Your state, you have to pay your state tax. So North Carolina, most of us have to pay a $200 franchise tax. That should be paid at the same time. In fact, in North Carolina, the deadline is April 15th for that. So as long as your $200 franchise tax is paid by then, that's fine. You don't have to apply for extension for the state automatically in North Carolina. It's accepted, the federal is accepted. Same with South Carolina. Don't have to file a separate extension for South Carolina. And I think franchise tax in South Carolina is $25. So make sure you pay that. C Corps, individuals, are due April 15th. Extensions available until October 15th. That's the C Corp. And then 1041s, that's estates and trusts, have to be filed by April 15th as well with an extension. Estates are a weird one. You can elect. If you have an estate, you could choose to file a fiscal. So if the person died, say in September, you could choose to file a tax return next August, within 12 months of the date of passing, or you can file a calendar. So if they die in September 24, you either file a December 24 3-month tax return or 4-month tax return, or you file an August 25 12-month tax return. You can choose that, only for estates. Trusts, not so. Just for interest's sake, estate and gift taxes are not income taxes. It's a whole different code. Relates to domicile and not so much residence. What essentially happens with estate tax is when you die, the IRS comes along. You thought that, death and taxes. The IRS will come along. They'll add up everything you own, everything you gave away during your life. They'll subtract an amount and they'll tax you 40% on what's left. 40% of that's like nearly half of what you've got, and that's the assets. So if your house is $1 million house, and there's no mortgage on it, they'll come along and they'll take 40% of the value of the house. And that's why a lot of these farmers and people who've got farms that they've inherited down the years have run into problems because they can't go and sell the farm or a piece of the farm just to pay the tax. It becomes a liquidity issue. Fortunately, Tax Cuts and Jobs Act brought in an exemption of $13.6 million. So you've got to be super wealthy. You've got to have a massive farm and all sorts of assets to exceed that limit, and that's portable. So between a husband and wife, you can borrow the $13 million from your spouse effectively. And so it's a $26 million estate you have to exceed. But there's always talk, again, a Tax Cuts and Jobs Act doesn't get extended this year. Then we go back to a much lower level, and I forget what that level was. But I know 2008, the exemption was $1.8 million. That's not that long ago. That we were at those sorts of levels. The other exemption you get is you're allowed to contribute or gift anything. This year it's $19,000. So if you gift somebody $19,000, that doesn't get reported anywhere. You don't have to tell the IRS. It doesn't get included in your estate computation when you die. Those gifts are per donee recipient. So if you've got 3 kids, you can give them each $19,000. If you've got a 5-9 plan for your kids, you can actually do a catch-up and do 5 years for each child at one time. Well, you can't make for the next 4 years, but at least you can sort of borrow from the next 4 years and make a 5-year contribution now and not have to file the 706 gift tax return.
So does that child, there's a 5-year look back. There is no 5-year look back for the gifts?
No, I think the look back is more applicable for Medicare, isn't it? Medicaid to see what your assets are. That's if you give something away within 5 years or 4 years, I thought it was, then the government can see through that and treat it as if you had the asset and you were worth that at the time. But the 5 years I'm talking about is you can borrow the next 5 years $19,000 contributions, gift tax exemptions, and make just short of $100,000 contribution to a 5 to 9 plan now, and still not report it because you're using that exemption, that 5-year thing.
But for Medicaid, will they not look at that, or they will look at that?
They would probably consider that part of your wealth for determining whether you qualify for Medicaid. Yeah, I'm not an expert on Medicaid. Yeah. BOI, I don't know if you've heard about this. There's a couple of words that come to mind, but it's a mess. So we're particularly frustrated because we had a lot of clients coming to us wanting this done in order to do it properly, because the penalties are huge, $500 a day if you don't file this BOI report. So the penalties were huge. And if somebody comes to you and says, well, you file this for me, you better damn be sure you get it filed, and if there's 10 of them or 20 of them or 100 of them, it could bury us. So we went and spent money on the software to control the whole process, a substantial amount of money, and then get told by the courts that no, the legislation's invalid, cannot be enforced. So the current status of the BOI filing is it's voluntary. They recommend you do it, but the court ruling at the moment is that it's unenforceable.
Did anyone get fined? Or
No,
they've
no.
not enforced it yet? There was no.
No, because it's unenforceable at the moment. So we filed, I don't know, we probably filed about 50 of them. Nothing wrong in filing. It's irritating that there's such government overreach into this kind of thing, but they've got their reasons, I guess. But that's where we are on that. As of today, it's still voluntary.
But Craig, I thought that some firms were still recommending filing so that way in the event that it went the other way and they can't retroactively go back and fine you because it was voluntary, but now it's not voluntary. And
No, the latest from the AICPA is that they're going to change the deadline to January 26, but they've still got to make it legit. So what FinCEN itself, on the FinCEN website, what they're recommending is collect all your data, because if it does become valid, then you can file straight away. But you're right. I mean, if it's now, they come out and they say it's valid, you're past the January 1st deadline, could you get penalized for only filing now? Well, I think it's unlikely that's going to happen. That won't happen. But it's there, and it's a requirement, and we've all got to do it. And a crazy thing is that if you've got more than 20 million in sales, you don't have to file these things. So it really affects us, small business owners.
Do we have to, I know we don't have to do it at all, but the intention was that somebody does it once or once every 5 years? Or?
No. Once, you file it once and any update. So there's even suggestion if you change your driver's license. Because we had one case where somebody's driver's license was about to expire. And the advice we got was you're going to have to refile an updated BOI when you get your new driver's license. So that's why it bugs me, because they come out with this innocuous little thing, oh, you just file it once and let us know who owns your business. And then you dig into the weeds, oh, no, we got to refile it when we change address, and got to refile it when we get a new driver's license, we refile it when we got a new shareholder. So suddenly it becomes this ongoing thing, and it's just another piece of red tape we have to deal with. I know it's my game and we make money out of red tape, but it does frustrate me as a business owner that you have all these additional regulations and you wonder what the benefit is. I mean, it's not as if we in this room are the biggest crooks and money launderers out here. The money launderers have got a lot more money than the small business owners. So anyway, yeah.
Was the objective to crack down on shell companies?
I believe that was what it was for.
Okay.
And, with all the stuff that was going on, the last couple of years, trying to track down all the, these funds that flow. And that's what bugs me. It's the big companies, it's big money. You're talking millions that get sloshed around in all these offshore shell companies. And you say, but here's us just trying to make a couple of $100,000 a year, and you're loading another regulation on us. But that's the law of the land. So speak to your congressman, congressperson. So questions next week, or next month, sorry, is I'm sure Alan will tell you more about this. Is there anything I didn't cover or that you're interested in? Sorry.
I do have another question, but I should know this. Capital gains, that is not considered earned income, right?
Capital gains is not earned income, no. So the distinction there is, it's an important distinction, but if you have earned income is anything from labor. So anything that you do to generate, where you put effort in to generate an income. So it can be Schedule E if you have your own business, and you've Schedule C, I mean. If you have your own business and you sole proprietor, that's earned income. If you if you're working for a salary, that's earned income. Earned income is subject to payroll tax, 15%, plus regular tax. That's why the S-Corp structure is clever, because the income that comes off an S-Corp is not earned income. So you avoid self-employment tax from an S-Corp.
Craig, could you explain qualified dividend versus unqualified dividend?
The best example I can give you is if you buy a REIT, like
An ETF or something.
EGNC, no, not an ETF, a real estate investment trust, some mutual funds. They get a special tax treatment, which basically says if they distribute 95% more or more of their income to their shareholders, they don't pay tax. So that company is distributing basically all its profits not pay tax. That means the recipients of the dividends have to pay the tax. That becomes a non-qualified dividend.
Okay.
So any company that pays tax itself and then distributes a dividend is generally a qualified dividend. Most public companies are pay qualified dividends, but if you have your own company, like a C Corp that you set up, and you pay yourself a dividend out of that, that is a qualified dividend. An overseas company that pays a dividend, as long as it's paid tax, then it's a qualified dividend.
Okay.
So one of my favorite stocks is HENC, which is a mortgage REIT. They distribute all of their profits. Those are non-qualified dividends, so they're subject to regular tax rates, average rate of tax.
Realty Income Trust, Tower is another trust that distributes everything. There's one that strictly has real estate holding servers, because all this AI, and people don't want to house their own servers anymore, so now they're renting property, and that's one of the popular real estate income trusts that my clients have as well. So there's a bunch of them out there. They get their own tax documents.
If someone loses a lot of money in a scam, is there any tax applications?
They lose a lot of money.
Lose.
Yeah, there's a thing, it'll be a capital loss, so you can deduct it. The word they use is worthless stock. So if you buy something and you've got to be pretty certain that it's gone. It doesn't have to necessarily have declared bankruptcy, but you need to be able to say that, there's definitely no chance I'm going to get this money back. And at that point, you can then claim it as a worthless stock, which is a capital loss. You put it on Schedule D, and you just put in the cost and no proceeds. Doesn't help you all that much, because as you probably know, capital losses you can only claim against capital gains, or $3,000 a year against your other income. It's kind of ring-fenced a little bit like that.
And do you know anybody who would be able to differentiate a real crypto platform versus the sham ones that these scams are setting up?
If you find someone, let me know. That's the trick, isn't it? I mean, they scam artists, so they're good at it.
Oh, they're so good. I have somebody that's in for almost $1 million.
Yeah. No, it's a shame. It's tragic, and they're so good at it. I had a call from someone pretending to be the IRS, and I deal with the IRS personally. And this guy phoned, and I actually got panicky. I thought he was onto something. And I got back to the office. I was in the car, and I thought, this sounds so real. And I got back to the office, and I was phoning, and yeah, it was a scam. And so I feel for them, for people who get sucked in by it. But thank you for your time.